I'm going to go on to kick things off real quick. My name is Ryan Cobbins, and I'm with Energize Colorado and the GAP Fund. And Energize Colorado is proud to bring you the Energize Community Program, which provides funding readiness workshops, GAP Fund low interest loans, and an accelerator program to further your business. This program includes technical and business advisors to assist you with a broad range of issues facing Colorado small businesses. Our low interest loan program is funding up to $20,000, 36-month or 3-year terms with an interest rate of only 2.5%. Funds can be used for payroll, for rent, lease payments, utilities, debt consolidation, working capital, equipment, inventory, and also capital improvements. This loan program is for businesses of fewer than 25 employees in 3 geographical areas that include Pueblo, Southwest Denver, East Colfax, and also childcare around the state. And so over the last several weeks and over the next week, we'll be providing an assortment of workshops to better prepare our small businesses to apply for not just our GAP Fund loan, but other opportunities around the state. And so I'm going to kick it over to Rebecca, who's our program director of Energize Colorado.
Great. Thank you, Ryan. And welcome, everyone. We're so glad to see you and so glad to see those who come back for our final funding readiness session. We're so grateful that Brian Estrada from the Southern Colorado SBDC is back with us, willing to answer questions and share this really important information. He will be going over financial documents that won't only help you apply for the Energize Colorado GAP Fund loans, but any loans that you're looking at through the state, through funders now and in the future. So I will turn it over to Brian. We're so appreciative of him. He will share his screen. Feel free to drop questions in chat as he's going, and we'll make sure to get those answered. So thanks, Brian. Take it away.
No problem. Thank you for having me again. Hello, everyone. Let me just go ahead and share my screen here. All right, so we are going to go over some financial statements. This moves pretty quickly. So if you do have other questions at the end of it, I can answer those. And I also give you my contact information to help, but we all also have other resources to help you with some of those questions should you need it. Okay. All right. So financial statements 101. All right. What we're going to cover today is I'm going to do a quick overview of what we discussed on Tuesday in regards to the profit and loss statement. Just in case you were not here, you kind of have an idea of what you need for this form. It's also known as an income statement to some of you. Okay, and then part 2, we're gonna review what a balance sheet is, how it should look, what it's used for, and then we're also going to talk about projected financials. All right, and then some of you think of projected financials as your forecasting, where you're planning for the next year. Okay, and then we'll wrap it up pretty quick with some questions and things like that. Okay, so one of the things that I always say is financial statements are created for 2 primary purposes. The first one is IRS reporting, and the second one is to help owners manage and grow their business. Okay. All right, so we're going to give you a quick guide to what a profit and loss statement is and how to read it. Okay, basically a profit and loss statement is a summary of business transactions over a specific period of time. Generally, this is a month. Some businesses can do it on a quarterly basis, and then you run a final one at the end of the year that shows all 12 months. It's good to run a profit and loss statement once a month because it kind of lets you know what, well, not kind of, but it does let you know exactly how your business is doing, because we need to face the fact that numbers do not lie. So the profit and loss statements, it's one of the most used reports for business owners, lenders, and taxpayers. It tells us whether a business is profitable or not. It reports how money flows in and out of a business over a specific period of time. And then the numbers, when you're looking on where to find these numbers, they come from tracking your daily transactions, taking a look at your bank statements, your credit card statements, invoices that you create, or any other documents that you use to run your business. If you have a point of sale system and you're entering all the data in there regularly, then you have this information available to you. All you would need to do is figure out on your system how to run these specific reports. When you're putting this report together, the standard format should include your company name, the dates of the period of time that we're reporting this, a list of your chart of accounts. Your list of accounts is your different revenue accounts, your different expense accounts, etc. You should have that list there so you can see the data for each one of those sections. It should have a revenue section. You should take a look at your cost of goods or variable expense section. It should have that. Should also have an operating expense section. And then finally, a listing of your net income, AKA profit or bottom line. Keep in mind this simple equation when you are taking a look at this. It's revenue minus expenses equals your profit or net income. All right, so let's talk about, whoops, I have profit and loss statement. Whoops, I went backwards. Sorry about that, guys. We're going to talk about balance sheet and financial projections. So what is a balance sheet? It's a snapshot of the financial condition of a business on a specific day. So today, if I ran a balance sheet, this is what my business looks like. In 1 week, it could be different because I either sold some equipment, I collected some invoices, I bought something, so now I have a new liability. So it can change within a week. So always remember that the balance sheet is for a specific day. It tells us how much a business was worth when it was created. It's a statement of the financial condition that portrays the strength of the business. It reflects the business's ability to continue as an ongoing concern, pay off debt, or survive a threat. It tells us whether or not owners have equity in the business. A business is considered upside down if the owner's equity is negative. This means it owes more than it owns. All lenders will take a look at that, just to see where your business is standing there. The goal is to strengthen the balance sheet by increasing assets and paying down debt. This practice builds a resilient business. And then remember, debt is generally considered a business risk unless it is used to purchase income earning equipment. So when we're thinking of income earning equipment, I always go to think about a restaurant. And you're going to buy a stove and you're going to get in debt for the stove. But that stove is going to generate income for your business. So that's a good debt to have. Okay. So it also goes on to tell us the value of the assets. It looks at short-term assets and fixed assets. When we think of short-term, these are cash, inventory, accounts payable. This is something that's readily available that we can collect right away, that we have access to. Fixed assets are things that it would take longer to collect money for, or things that we can't convert into cash right away, but they're worth a decent amount of money, so we want to hold on to it. That could be your real estate, your equipment. Think of the stove example again. Okay. It also tells us how much debt a business has, short-term debt, utilities, upcoming payroll. And the easy way to remember short-term debt is debts that can be paid within 1 year. Anything that's longer than 1 year is considered a long-term debt. Okay, so in long-term debt, it would be bank loans that you use to purchase that real estate, or if you bought a delivery truck, or if you bought a stove, those will not generally be paid off in 1 year. Okay, the balance sheet information will come from a variety of sources, such as bank statements, credit card statements, accounts payable records, net income or loss from your profit and loss statement, your inventory records, Okay, you always want to make sure that you're keeping track of inventory because that is considered an asset. Okay, sometimes if you have too much, that can be considered a liability because you can lose some of that product. So you do need to make sure that you're keeping proper inventory so that you know how much money you actually have sitting in your storerooms or sitting on your display floor if you're a small retail business. Okay, the breakdown of it continued here. This is how you would set it up, is we would have a company name, and again, the date that this was created. What's different from this than the profit and loss statement? It's not a specific period of time. It's one date in time. It's a snapshot. Okay, you would have your asset section. This is what the business owns, such as current assets are those that can be converted to cash quickly, as I mentioned before. So bank accounts, accounts receivable, inventory, fixed assets, real estate, heavy equipment, vehicles. They cannot be quickly converted. Always remember that. Your liabilities section is what the business owes. So again, we're going to look at current liabilities, and you want to list it as current liabilities because anyone who is looking at this will say, well, this debt will be gone within a year. So that can also change the way that things are looked at your business. All right. Long-term liabilities, money owned on long-term debt, such as mortgages as well, vehicle payments, any other loans that you've taken out that will not be paid off within a 12-month period. Owner's equity. This is what is left after you've subtracted all of the liabilities from the assets. And this is what you want to see, how much owner's equity you have available in your business. It shows that you are invested into your business. So again, a simple equation for your balance sheet: total assets minus total liabilities equals owner's equity. And as an owner, you want more equity in the business. So here's a couple balance sheet examples. These were taken off the internet. Microsoft Office does have some templates for you. I sent out some links last week that you could go to look at on Microsoft Office for the profit and loss statement. I will also send a link so you can find some of these examples of balance sheets should you need to do them manually if you don't have a POS system. But again, balance sheet lists the assets on one side, and then it lists the liabilities and equity on the other side. Okay, and then at the end of the day, your total assets and your total liabilities and equity should balance, right? You want it to balance. That's the name of the balance sheet there. All right. The other example that I have here, let me make it a little bit bigger so everybody can see. I'll slide this over just a little bit. Okay, I don't want to make it too blurry for you all, but this one's a little bit more detailed, and it shows the current assets. So it gives you cash. It's showing what year that you're running. Generally, a balance sheet statement is ran at the end of the year, the end of the quarter. So you could always put the year that you ran here. And then it shows prepaid expenses, because that's an asset. You've already paid those. Short-term investments. Then it goes on to list your long-term assets, any other assets that you could have, like deferred income tax, other investments that you've created for your business. So you would put that, and that lists your total assets. And then on the other side, you know, this one has a financial ratio percentage amount to show to like lenders or tax preparers. You generally don't need this little section here, but then you would go on to your current liabilities, and again, list accounts payable, short-term loans, income tax payable. And I can't reiterate this enough, but remember, these are anything that will go away in 12 months. Okay, long-term debt is there longer than 12 months. And then again, owner's equity. So what you've invested into your business, what retained earnings, profit that you put away, and any other equity that you have in the business. You would list there. Let me bring this back down. All right. Let's talk about financial projections. They're financial statements that forecast the future performance. Unlike your P&L, which reports past performance. But you need your P&L, your profit and loss statement, to help you foretell the future a little bit. Okay, we need the past to kind of tell us what's happening so that we can kind of see the processes that our business goes, what happens in fall time. So you look at that quarter. What happens to your business in the winter time? What happens in the new year? And so we can all take a look at how the business goes this way, has a down, has an up, and it tells us what our cycles are going to be. So the projections are taken from past operating data and other sources to provide a best guess as to your future performance. So generally, when we look at our profit and loss statement from the past, we would take a look, and some people do a percentage when they're trying to forecast the future. So they would say, I would like to see a 5% increase in sales. Okay, so then you can project that for over periods. So let's say we made $1,000 in sales. This is just a simple number. We would multiply that by 5%, and then we would add that. That's what we would want our new sales to be. Okay, in this economy, it's kind of tricky. So if you say you want to increase your sales by 5%, you also have to look at how much you're going to have to increase your expenses as well. So you can look at that as a percentage basis as well. You can find what our current inflation rate is running, and that's how you would be able to track. You can look at past invoices from your food vendors to find out how your expenses are fluctuating or increasing. The other way to do this is take a look at what you've made and then just say, all right, I want to increase my sales by $300 each month. And that's how else you can make that happen. So financial projections are usually used primarily by lenders and owners to make future cash flow decisions and investments. What are we going to do? What are we going to buy? Do we have enough money? Will we have enough business to cover a new payment on a stove or a new payment on a delivery truck? When you're creating your financial projections, I always tell everyone, you can think about that the sky's the limit, but be somewhat conservative, because you don't want to set yourself up for disappointment because you don't hit that number, but you also don't want to put something out there and then not be able to hit it at all. And it can affect the overall operation of your business. So be conservative when you're making these financial projections. All assumptions when you're creating these financial projections should be clearly stated and accompany the projections. So you need to say, I am estimating my sales to increase by 5% this year. I am estimating my expenses to increase by 3.5%. So that leaves me 1.5% of actual sales increase. So you may say, that's not really what I need to do. So maybe I need to say I would increase my sales percentage by 10%. Okay, you know what your business is, you know what your market is running, so then you can make the final decision on how exactly you're going to set those assumptions. So as a reminder, as a business owners, it's important to understand the value of the information provided in the statements that we've discussed. Okay, and always remember, we wouldn't fly an airplane blindfolded, but many business owners try to run their business without really understanding the financial side. If you don't know all about it, what's happening, and you just send everything off to a bookkeeper or your accountant, you need to also stop and take a look and review those so that you know your business. Always take the time to educate yourself. I put an example of what a financial projection could look like. Okay, this one calls it a income statement format, but you can see here that we've done revenue. And year one, we made 40,000, year two, 75,000, 100,000. So each year we've increased. We've put what our gross margin should stay at. We always want our gross margin to be 55%. We know what our cost of sales is based on the data we've collected, either in our Excel spreadsheets that we keep or through our POS system. Okay, any like research and development that we're doing, sales and marketing formats, operating expenses. We know what our rent is going to be. We can keep track of our utilities so that we know that, you know, we have to allow for equipment repair. So we've got to fill all of these things in. So you've got to really put some thought into it when you're taking a look at it. These assumptions here, like depreciation of equipment, we're assuming that we're going to take 20% of depreciation. We have 4% finance costs to finance our operation. Okay, we have our income tax that we have to do. You can add up here, you see my cursor moving. What was your assumption on revenue? How is that increase? So that you know what you thought of. And then when you go back to look at it, that really wasn't a good call. Let's go ahead and try this. Or, oh, we were too conservative. Let's try something new. Okay, so that's what a financial projection could look like for you. All right, so in summary, the profit and loss statement, the balance sheet, and projected financial statements have guided business owners, lenders, and tax preparers for decades. Understanding and using these will increase your odds of building a successful business. As I mentioned before, let me shrink this up a little bit for you here. You'll get a copy of this presentation as well. Rebecca will send that out, but there is my email address if you have some simple questions that I can help you out with. That's also a link to my website. We have business consultants that can help. We have SBDC centers throughout the state for you. Energize Colorado also has consultants and individuals that can help answer questions as well. We work together as a partnership because we want all of you small business owners to be successful. All right, so that's my quick presentation. We always do it quickly so we can take some time for questions if you have any. So I'll hand it back over to Rebecca and Ryan.
Thank you so much, Brian. So I'm going to leave space. Any questions, Brian? I feel like you can do that in your sleep now that you've done it so many times. So we so appreciate it. What questions do we have? All right, well, I have dropped in the waitlist link. If you want to be the first to find out about the Energize Colorado Gap Fund loans, feel free to click that link. The second link for Startup Space that I have dropped in is for our business advisors. So you can reach out to Brian. You can reach out to our business advisors for any support on creating these documents. So if there are no questions, short and sweet, Brian, we appreciate you. You've done this for us so many times and we're really grateful. And I'm sure we'll be sending people your way. So have a good evening.
All right, and I appreciate you guys and all you're doing for the small business community. So thank you again.
All right, have a good night.
Take care.
Bye.
Bye-bye.